Alrighty, guys. Hopefully you can hear me here. Still kind of unfamiliar with the audio settings. I'm using a AMD Radeon to record a lot of these videos. So it's been a while since I've posted one of these, but I just wanted to walk you through very high level this new model that I built for CD Projekt Red. For those of you that don't know, that aren't really into the video game publishing space or the video game space in general, CD Projekt Red represents a AAA video game publisher, and they're behind some of the most blockbuster RPGs that we've ever played, right, in the gaming community. The Witcher Saga and Cyberpunk, which really had a rough start. Cyberpunk was not fully optimized for the older console generations, PS4 and some of the Xbox models, and a lot of people had issues playing the game, even running it on very high quality PCs. But the game has since recovered, and it's actually doing really well after the Phantom Liberty DLC release. So I'll just walk you through the model here, or maybe I'll just show you the model, kind of let you see how I break things down. Everything here is in the local Polish currency. This is not in USD. So you can see the revenue from a top line perspective. $2.1 billion in net sales in 2020, and obviously after an IP catalyst year, right, revenue is going to tail off. They're not releasing blockbuster video games every single year. A lot of production and costs and human capital goes into making these games, but it still is amazing, right, to see how much revenue they actually brought in when they released Cyberpunk, and that's what happened in December of 2020. And then revenue tailed off. So here's the projection, and I can get into the projection later, but I'll just keep walking you through, just giving you a high-level overview of the model here and how I like to look at financials. So this is a three-statement model. It's kind of a quick and dirty. I mean, this took me a few hours to build, probably 6 hours total to build. So here's the balance sheet. Ignore this. I mean, this is kind of just a formula that I write to make sure that my balance sheet is actually balanced in the stage one. It is balanced, as you can see. So don't worry about this. Get into the cash flow statement, which realistically, when you're modeling a company out, you don't even really need the cash flow, the historical cash flow statement in there. All you need is the income statement and the balance sheet to create this, right? So you might see analysts sometimes just forego this and potentially you'll see something like this in there, right? Well, that doesn't really do it justice, but they'll just leave this totally blank, right? Because you don't really need the cash flow statement to build a financial model. But I like to look at where CapEx is historically and cash flows from operation. See any acquisitions, right? Company is hardly any debt, actually no debt. They have zero debt. So in an environment like this, a macro environment where rates are so high and the cost of capital is just so high, I think that's leaves them in a pretty lucrative position. I don't foresee any equity raises going forward. So they are in a very good position right now. Just see some pretty simple formulas here, just free cash flow and obviously normalized free cash flow. Some supporting schedules down here to isolate very important metrics. Property, plant, and equipment, CapEx, right? Property, plant, and equipment on the balance sheet is really just aggregate of ongoing capex and ongoing depreciation. It's just net PP&E, right? Capex is just additional purchases of PP&E. So you can see the formula here, kind of how this doesn't really matter. These are all, but if you want to forecast it, this is how I go about it. Stock-based comp, you typically grow that with revenue, but it's kind of what I'm doing. As revenue is growing, I'm keeping it kind of flat with revenue, right? Accounts receivable. There's multiple ways to forecast accounts receivable. Typically, when a company is growing, accounts receivable will grow, right? I mean, it's just kind of how businesses work. As they grow their revenues, their accounts receivable, the amount that's owed to them will typically increase, right? People tend to pay on credit, so especially businesses. So that's just kind of a normal course of action there. But there are multiple ways to model this out, and sometimes you can actually have a trigger over here, a 1 or a 2 that you can enter in, or maybe at the top of your model, that you can enter in and kind of have different scenarios, right, for accounts receivable. I kind of forecast these with using a receivables turn, and I kind of keep that at a level moving forward. You can see, I mean, there's not a whole lot of variation going on in here. I mean, they increase in, I think this is 2026, 2027, just because that's going to be their next catalyst year. A lot of people think that the new Witcher saga will commence in 2026. So to forecast receivables, you really just take an average of the prior receivable days, right? Receivable days, it's just how many days is it taking this company to kind of cycle through their receivables, and they're turning their accounts receivable almost 6 times since 2022, which is an average of 63 days, right? So you just take an average of that and forecast it forward, right? And you can get your receivables turn, which in effect will give you your accounts receivable. It's kind of a backtest formula there. Accounts payable, same thing. And you can build more of these schedules. You can have an inventory schedule, right, which I probably should have, but just due to the nature of AAA gaming companies, I mean, they don't really carry a ton of inventory. So you can just go take a look at it. Inventory is really non-existent. So other really important aspects of this model in terms of forecasting is margins, right? So you can kind of see how I forecast here. Revenue growth, which I just hard code there as indication, as is indicated by the blue font down there. These numbers are hard coded. These first 3 years, I should say that the next 3 years, but the first 3 years of the forecast period, they really don't matter much. These companies really are highly dependent upon the success of their next IP release, which is going to be in 2026, is at least the year that I expect it to be released. And judging from the prior IP release year, when they released Cyberpunk, I mean, you had a 310% year-over-year increase in revenue, as you can see. So as the company's growing, as video game popularity is growing, I do forecast a pretty large revenue increase in 2026. So 150% is kind of being a little bit draconian, although revenues have greatly increased, right? I mean, I'm forecasting revenue is going to be double what it was in 2019, right, which was the year before their most recent IP release. So, but it's still going to be a significant year for them. The next 2 years, right, they're going to be releasing DLCs and kind of like The Witcher 3. We saw that game get released in May of 2015, and subsequently we saw over the next year 2 phenomenal DLC releases for that game, which we probably don't see because I started forecasting and I started this model in 2018, so using 2018 financials. A little bit of color on the gross margins here. I'm keeping them at 75% for the next 2 years and casually growing them. And this is really just due to the fact that most games are actually distributed digitally, right? So you can just refer to that as digital distribution, and it's definitely a tailwind for the AAA publishing space. I think hard copies are actually going to be non-existent by 2025, and games will strictly be released digitally, minus the potential collector's edition items, which will actually go up in price and be another catalyst for video game companies. But when you it's called disintermediation, when you're getting rid of kind of the middleman, the distributors that are actually distributing your game to retailers, right? You're getting rid of that completely, and all the costs associated with that are going away. And EC margins have gradually increased over the year, right? Over the years since 2018. These were actually in the 60%, gross margins were actually in the 60% range the years prior to 2018. So just a really important takeaway of the overall video game landscape. It's very beneficial to these companies. SG&A, I actually see this going down or staying. This is really draconian if you think about it. CD Projekt Red has already laid off about 9% of their staff in 2023. And, you assume that, A, they laid off a lot of underperforming developers and potentially story writers as well, right? Because ChatGPT and generative AI is kind of taking the lead there. So you could actually see these, be more in the 30% range instead of mid 30% range, low 30% range, sorry, instead of mid. But I'm keeping them at 35%. Tax rate, I just have at 10%. I mean, the Polish tax rate, I think, is more along the lines of 20, 24, 25. I have to look it up, but historically they've been paying an average of 6.5%. So anyway, I don't want to get too deep into this. I mean, there's so much more that we could go over, but I just wanted to give you a quick rundown of kind of the 3 statement. Here's kind of my basis for forecasting, right? All of the recent AAA blockbuster RPGs and kind of their first year copies sold, potentially using this as a proxy for the next IP year. If you think about it, I mean, a game like Elden Ring, which I think is one of the best video games of all time, did 21 million in the first year. Then you also have a game like Hogwarts Legacy, which to me was not nearly as impressive as some of these other games, did 20 million. Did 20 million in the first year. And that's because Hogwarts Legacy had a massive underwriting. And you had basically a ton of Harry Potter fans buy this game. I'd already had a kind of a pillar to stand on, right? So that's why that game did so well. And The Witcher now has a TV show, right? They're kind of using that flywheel concept and expanding some of their IP into different areas to generate more popularity. So I think the Witcher series is key to this valuation, and I foresee this next Witcher saga performing really well. Up here, just some notes and news that I keep track of. Their pipeline. They have a co-op Witcher game. They have Project Polaris, which is the start of the new Witcher trilogy. This is going to be the 4th installment of The Witcher. They are actually remaking the original Witcher title. From what I've read about this, it's going to be way more expansive than the original Witcher game. It's going to be completely open world, and they're really going to redo this game on a whole nother level. And then you have Project Orion, which is the next Cyberpunk installment. Here's the valuation summary. Quickly walk you through this. So I have it valued at about $10 a share, and right now it's trading at about $6.70, which is growth of about 48%. I could actually enter that share price in. I think it's probably trading at just in local Polish currency, but so yeah, the valuation, there's some upside there. The equity is fairly illiquid. I mean, I don't recommend going out and placing any market orders on this, and you're going to have to be very patient to accumulate a decent position here. But there is some upside. There is some upside. I mean, this has been battered over the years after the horrible release of Cyberpunk. You look at some competitors, right? Here's our target company. I mean, the valuation is a little rich. That's a little rich right now. But their gross margins support that valuation, and their EBITDA margin, I mean, nobody else is really close other than Nintendo. I'm sorry, guys, I just ate breakfast there, so. But overall, I mean, this is by far the highest quality AAA game developer on the market right now. That's public. Other comps that are really embedded within these names, right? Electronic Arts, they own BioWare, which has developed games like Dragon Age, right? Other RPG games that are really direct comps to The Witcher. That was acquired. Take-Two has acquired Rockstar, which is behind the also the ever so popular games GTA and Red Dead Redemption 2, right? Ubisoft, they own the IP to Assassin's Creed. And then you have Microsoft, which recently bought Bethesda for, I think rounded it was about a $7 billion acquisition. And I consider Bethesda the closest comp to CD Projekt Red. And just on a back of the envelope valuation, we can do that right now. Right? I mean, there's potential just from an M&A standpoint of 180% upside here. I truly believe that CD Projekt Red is on the level of Bethesda. Bethesda, for those of you that don't know, developed Skyrim, Elder Scrolls, Fallout, and most recently Starfield. In terms of market comps, Bethesda is as close to CD Projekt Red in terms of quality and playability and real value. And so just something to think about. Just something to think about. And there's some data points here. I mean, really nothing, but if you're a programmer or even somebody who can just gather data, I'm sure there's a lot more raw data out there that could give you a better indication of how popular certain games were. But here I'm just looking at the peak of some of these games, right, in terms of player count. Now here you have Elden Ring, right? I mean, look at how vastly popular that game was. Hogwarts Legacy, which sold over $1 billion worth of copies in its first year. Cyberpunk, right? It's truly amazing. And here, which is very amazing, right? Cyberpunk is actually making a comeback. So here's when they released the anime show Edge Runners, and here's Phantom Liberty. So the game is still very popular. They've optimized the game for all platforms and all devices, and the game will continue to generate revenue. So it's another tailwind for this company. I guess just to summarize, there is upside here. Again, this model was put together kind of quickly, and some of the forecasting was done kind of rapidly. So, but still, there is some upside there. Trust me. So, not financial advice. But yeah, I think that I'm going to add this to my portfolio over the coming year.